index option, S&P 500 weekly, 1350 call, up and out of the money. On the other footnote, right here, 1350 put, daily chart. They were marked down from 3340 down to 2090 on the low. And that's a deflated weekly put. We're going to be trading this. If they mark them down, we're masters at these index options. And I've already given the MMTs all the price levels as we know it. But I want them to see that those lower price levels that I gave out, all the way down to $10.80, are highly likely based on a deflated extreme area. And that means that this 1350 call, which is totally the opposite, see, that's deflated in price at the bottom, marked down. Now, on the other hand, this 1350 weekly call right here that you can see, they had the lows when we were buying them over here at $2.50, in this range down on 6.4 when we put the bottoms in. Right now, we are from that level in price, MMT, we're all the way up here on the high of $13.40. That means that up and out of the money call, because this is an up and out of the money call, and we can clearly see that the index itself closed at 1342.84, 13.74 handles. And this was the Friday. And you got FOMC meeting, you got lots of stuff coming out. But let me tell you something. If they gap the market higher, they will gap this call up even more inflated in price, where I will be shorting the call outright at some point. If they gap this up, this is going to go up higher, and it's going to be super inflated within the 5-day volatility that starts on 6/18/2012. The price exhaustion is the relativity of resistance. So, as I have clearly said, if we go up one full delta in the S&P 500, here's where we closed, and that's going to be around 1356 on the S&P. And that's going to put us right here, right where my pointer is. And if that's the case, if that should be the case, that means that this goes higher in value, and it will be an extreme inflated value, and it will have to come down. And this will get extremely more deflated in the value from 33.40, and if we can get in down around 10.80, that would be great, because that means that they would have marked it down to $20. It will all be based on the gap open up and or gap open down. Right now, I'm dealing with the S&P 500. It closed at 1342. 1350 call is up and out of the money, and the 1350 put is slightly in the money because we're approaching that 1350 strike price. And if we gap up, we gap down, and we make our transactions here. And that's on the S&P 500. And now I'll get alarms rises too. MMT, not only that, we're going to be taking a look at that up and out of the money at that major resistance level at 1370 on the S&P call. And it's a weekly, okay? And basically what we're going to be doing is I can show you here in a level 2 of that 1370 call to 622 now, okay? And I'm going to give prices out because the thing about this range is because it's so far up and out of the money, that drop down bids, if there was a gap down, we're going to start setting alarms. We're going to want to know if this thing drops to $1.60 now. Close at 520. In the next round of videos, we're going to go to the 1370 call up and out of the money and the 1360 put, MMT. And basically, we'll do that in the next round.